G'day everybody, how you doing? I trust you are keeping well. Thanks for joining us today with Q&A with Whitey. And yes, the backdrop's a little bit different. I'm coming to you today from good old sunny downtown Tamworth. And at 7:38 this morning in Tamworth, the temperature was minus 0.2, but feels like minus 3.6. Go you good thing, Tamworth. It's rather chilly to say the least. Yeah, welcome everybody. Make sure you got your cup of coffee going. I'm traveling, and you know I'm always traveling, so I've got my iron mug with me, Iron Man mug, and there's a reason behind that. But given the language that goes with it, I probably shouldn't do it on this segment. So I'll tell you a story another day as to why I've got it. So get your coffee, get something to eat. I'm traveling, so I only get nuts while I'm traveling. Yeah, you get that. But we're all good to get going for Q&A. But first of all, we better say thanks to those that support us and to our sponsors that travel with us everywhere we go, to AAMC, Affordable Staff, ALI, AmFin, Credit Fix Solution, Early Pay, Finstro, Heartland, Insurance Advisor Net, Notify, On Deck, OptiPay, Pepper Money, Prosper, Strive Financial. We're going to hear more from them today, and Trailbook Loans. So thanks. It always makes these things for us to be able to bring them to you free of charge, which we've done for a long time. So thanks to our sponsors. At any rate, let's get on with today. And today, I'm very pleased to have I say dear friend of mine now. We've known each other for a very long time. It's Cam Garnham from Strive Financial. And even though he's a handsome young man, just remember, he's a loan shark from the Gold Coast. So we always treat those things carefully when we have these conversations. Cam's one of the good guys. I only jest. But Cam, welcome, buddy.
Hello, champion. Thank you so very much for having me on.
Mate, absolute pleasure. Thanks for spending some time with us. And hopefully it's a bit warmer up where you are on the Gold Coast compared to where I am, although it is warming up quickly.
It is beautiful here today. The weather, you're missing out. The weather's been beautiful all week. No wind, no clouds, sun out. A little bit chilly if you're in the shade, mate, but beautiful and sunny.
Thanks for that. It makes me feel so much better. I was in Queenstown, New Zealand last week, and it wasn't as cold as what it is here, so go figure. Although the daytime temperature didn't warm up. Yeah, is what it is. It's life. So, mate, to kick off today's conversation, what I really want to do is to start off and understand a little bit about what your journey's been like before you got to where you are today. I always find it fascinating to understand that we all start as something. I was a high school dropout, right? I got into year 5, which I think these days they refer to as year 11. I did 2 months of that. I actually got seriously ill at the time with glandular fever. I was off for about 6 months, came back and said, jam this, it's too hard, and bailed. So I failed high school. I'm a dropout. It's always, it's like, yeah, and failed in English and maths, and all I do is write documents and spreadsheets. It's my penance. God is punishing me.
Mate, listen, I'm not much different. Very similar. I did finish year 12, and if you get C's, like the very border, I passed, but I only did enough to pass.
Pass is a pass.
Pass is a pass. And I was always going to be a cricket coach, Whitey. I grew up playing a bit of cricket and doing some coaching when I was younger. I left year 12 and I went to go to the Sunshine Coast University. I was going to do science in exercise and sport as a pathway into hopefully coaching at Queensland Cricket. Whitey, I turned up the very first day to university. I couldn't find my class, and it's the only 37 minutes I've ever spent at university. I literally couldn't.
Got there.
Well, I got there, but I couldn't find where to go, and I literally never ever went back, much to my mum's disgust. I was done and dusted, and I started a couple of things. I went to Darwin that year and played cricket in Darwin.
Yeah.
So I spent 6 months up there. I came back. I started a TAFE course in. Back in that day, it was a justice course to possibly be a police officer. Yeah. I spent most of that time on the greens of the Caboolture golf course instead of in the TAFE classroom. So something else that I didn't finish But luckily enough, through my cricket coaching, and I was doing it sort of full time, I met a gentleman, Trevor Croner, who worked at Queensland Cricket, and he was into property, buying and selling property. So I was lucky enough at about 21, he took me under his wing, and I've been with Sarah, my wife, since 1999. We're high school sweethearts. We met in year 12. So we were 21 and he helped us buy our first block of land, and Sarah's dad was a builder, so we built our first house. And ever since then, I'd sort of always been dabbling in property. We were buying and selling some stuff. We were moving from one to another, which got me into doing some loans. And again, it all comes back to cricket. All the loans I was doing in the early days, I was doing through CBA, because the treasurer of the cricket club that I was full-time employed at was a CBA bank manager at Ashgrove. So I sort of had my little toe in the finance and how home loans worked, and having to buy and sell, and I was doing some investing in some property and stuff. And I was always just going to do that. And I was going to work for Queensland Cricket once a job come up there. But my little sister moved to the Gold Coast to do law, and anyone that's seen me on tour, she's the brains behind the operation, and I call her the overpaid in-house lawyer that we have, but she is the brains behind the organisation of Strive Financial. But she started working for Crown and Gleeson back in the day, when she was at uni on the Gold Coast down here. So it was through her that I ended up with a role with Crown and Gleeson, and I'd probably got myself in that much debt, Whitey, that a cricket coach role wasn't going to cut it anymore, and the finance sort of started to take off a fair bit more. And I ended up starting as the BDM for Strive Financial back in about 2005 or 2006.
Crown and Gleeson.
Crown and Gleeson, yeah. So that was right back in the day. And even back in the day then, it was still a family-run company. So Jonathan's dad, Warren, he was the owner of Crown and Gleeson, and started in about 2002. So Casey started working there while she was at law. She has obviously now, her and Jonathan have been married for about 14 years, I think, and they've got one little girl, who's just turned 13 last weekend. Time flies. I was going to say time flies. Only feels like yesterday, mate. But so Sarah and I moved down to the Gold Coast in 2006 when Bailey was born in 2006. So he was about 7 or 8 months old when we moved down, and we've been down here ever since. And I've sort of then played different roles, from sort of the BDM role to a fair bit of the credit side of stuff in looking at the applications and approving loans, to meeting with all of the borrowers and what have you. So I've sort of seen it from all different angles to where we are now, where Warren's obviously retired, and it's just Jonathan, Casey and I, the three of us, and you see it from a far bigger picture again now in obviously raising the money and having the investors and having the licenses through ASIC, and still trying to manage that side of it, which Jonathan does a wonderful job with. And I sort of get stuck.
Don't tell him that.
No, they do. I know. I take the piss a fair bit, but we're very lucky that the three of us work really well with each other, because we've all got different strengths, and that's what sort of makes us work the way that we can work. And I sort of have ended up in the broker side and the client side and that side of the business. But obviously we're all overseeing all things. And excitingly, Bailey started with us. He was only 6 months old when we moved down here and first started this. And talking of high school dropouts, he's the latest high school dropout.
He's going to be a legend.
I've got some different ideas around education, which are neither here nor there to a lot of people, but he knows what he wants to do, and he's been lending his own money for a little while now through the company, making his own decisions on his investments and what have you. So seemed like sitting at school mucking around with his mates at lunchtime was probably just wasting a couple of years where he could hit the ground running. And hopefully a lot of the brokers have seen him over the last couple of months. He's been on the road with us and at all the PD days that you guys wonderfully put on. So the exit plan, we call him. Everyone's got to have an exit plan, Whitey, very important.
That's your exit plan.
Is my exit plan.
And my son, when you come, mate, that's amazing what he's doing. It's always interesting. You know, from my point of view, it's always interesting. You look at where people start in life and to where they are today, and it seems that there's not that many, and there are some, but not that many that sort of start off at the beginning and keep going on the same trajectory. They're like, my plan when I was a kid was to be a commercial pilot. And I actually got my private pilot's license before I could drive a car. And I then wound up with a spinal fusion, and they gave me 70% chance being in a wheelchair. That didn't happen, but yeah, but the world moved differently and it became something very different again. And I can assure you, this gig was never on my agenda either. But that's a further story. But it's not about me. But
it's strange how it works, doesn't it? And I think back to high school, mate. The smartest guys, I actually met with one of them only last week. He's now a broker out in Gatton in Queensland, and he went through the banking system. But there's very, very few people that I know from high school that went and did uni to do X, Y, or Z that now, and listen, I'm getting old, Whitey. I finished school in 99, so we're talking 24 years ago.
This is old, my friend.
I know. Mine's not far away. But there's very few people 24 years later that are still doing what they left school to go to uni and spent 4 years and 50 grand on doing down the track. And I think it's a real eye opener for kids. I think we put a hell of a lot of pressure on them at school, and literally 5 years down the track, the results don't actually matter that much. Now, if you want to be a doctor or you want to be a lawyer or whatever, then by all means you have to have that degree and that piece of paper. But even Sarah, my wife, she finished school, never went to uni, never had any interest in it, and she's gone back and done school teaching when she was 35. She's 3 years into being a year 4 school teacher now, and she is the happiest she's ever been in her life. And I just think we get a little bit tied up sometimes, mate, in education, and especially kids when they're so young and they probably don't exactly know what they want to do anyway.
Yeah, no, I agree. I've never looked at the bit of paper when I've been looking at recruiting people. It's usually about what they are as a person and how they fit into the culture of your business. And it's more, well, it's significantly more than a bit of paper. And I think that distraction, even though it's not what we're here to talk about, that's all right. Yeah. Distraction, it actually distracts you from your future rather than letting things evolve. Be focused on what you're doing, but let it evolve to be what it be. I say there's very few people that start at ground zero and go all the way, but you may or may not know this guy, but I went to school with James Morrison. So he's a jazz trumpeter, right? Famous, worldwide success, has academies these days and so on. But he's one guy who, I can remember we were young kids at school and he used to get a bit teased because he's always up at the music room playing his trumpet. But he just kept at it, and an absolute legend, most magnificent musician. And even in high school, I still remember I walked into, we had like a concert area. It was called a Beanie Dome. It was in the era they used to create like a balloon effect and then spray concrete over top of it. Didn't work out so well. The bastard thing collapsed, but that's another story. I walked in there and there's a baby grand piano on the stage. And there's James with his left hand playing a piece on the piano whilst playing the trumpet in his left hand. It was just incredible, the accompanying piece. He was an amazing man. And as I said, he's gone on to worldwide success as one of the most renowned jazz musicians globally. But he's one of the few people I know that started at that point and kept going. There's just not a lot there.
Yeah, and it's interesting you talk about the person, mate, and the human being. And it's probably something that's come more through my coaching, but we even use it in finance, right? We meet with all of our clients face to face. I want to speak to them on the phone because we're backing the person as much as we're backing the property or the deal or what have you. And that's one thing that's a little bit different with us is that we've still got that personable touch with people. It's not sort of an AI thing making a decision on whether we're going to lend the money or not. And it works both ways. There's times when I meet people and I become less comfortable and there's less chance that we're going to do the loan. Then there's people that we meet and we actually back that person because that person is who they are.
That's a very interesting point, though, because with technology, you can't get that, sake of a better term, that gut feel when you speak to something, something's not right. Or alternatively, look, the paper doesn't make a lot of sense, but this person is actually on the money. This is a person you want to back. And you can only do that with human interaction. And
it's really important to our business, desperately important, and for both sides of our business, right? Because and I explain this to people all the time. We have our broker borrower side of our business, but at the same time, we're sort of a middleman as well, because we have our investor side of the business. So we promise our investors we're going to do X, Y, and Z, and we need to be able to do that on that side. And one thing that makes the investor really comfortable with us is that I say I'm going to go and meet this person face to face before we lend them any money, and I'm going to get a real feel for that person, that they know what they're doing and that they understand the consequences and they understand how expensive it is. And that's the sole reason that we have so little problems within our business.
And it's not just relying on somebody to read a bit of paper and hopefully they understand what they just read.
It's because and short-term lending, mate, as you well know, can be really, really valuable to a client's business. Cash flow is king 99% of the time. But if it's the wrong person in the wrong situation, it can be and the wrong lender, it can be very, very detrimental to their business as well. And it's something that you desperately want to stay away from.
Okay. So Cam, let's dive into that private lending conversation a little bit. And from your perspective, how long has actually private lending been a thing as such? Like, has it always been there, or is it something that's evolved? Or how long has it been?
Listen, it's definitely evolved more, Whitey. So as I say, Warren started back in 2002, so it's been around at least sort of that 21 years there, and it's always been around. Yeah, and you've been around far longer than I have. It's always been there.
Thank you.
Just a reminder for everyone out there. But so it's been around a long time. What I would say is that it's become a lot more mainstream.
Right.
And what I mean by that is that it used to be fairly shadowy right back in the day. And we joke about the bikey loan shark stuff, but that's where you had to go and get money. If you were desperate and you needed money, quite possibly that's where you ended up getting money, if we're talking back in the 90s or what have you. There's been a real explosion of it probably since the mid 2000s with the cash flow lending, because cash flow lending didn't exist when I started in sort of 2006. There was no Prospers, or there was no Business Fuels or these types of guys that were lending against your income in a bank statement, virtually unsecured. So that has probably made it a lot more mainstream, I would say, because they're big companies that have had massive advertising campaigns over the years and are trying to grow as quickly as they can. So I think that's probably brought it more mainstream. What it has done is made it a lot more competitive, hence a lot cheaper for the borrower. We're talking back in the early 2000s that it was private money could be 10% a month. Like it was really expensive, where now you're talking virtually about credit card rates, right? You're usually talking somewhere between sort of 20 and 24% on a second mortgage. And then all the costs in that are typically tax deductible if it's all for business and company borrowing and what have you. So like the end cost of the client might be 15 or 16%. So when you're talking, it was 10% per month. And now you're down talking somewhere between sort of 1.5 to 2% a month. So that has been created by the competition.
Right. I was about to say, what actually drove it into existence? Was it a lack of competition? Was it like we look at broking. Broking, if you go back to the early 90s, really was driven by the bank shutting down branches, and then borrowers saying, well, shit, who's going to sort out my stuff for me? And brokers went, I will. That started a path that just kept going and going and going. What was it for the private lending sector that actually, I guess, gave it existence and then drove it to where it is?
Listen, I couldn't say from the very start, right? But what I can tell you is what drives when we're busy and when we're not busy at the moment is the access to capital. And I could only assume that that's where it started from. It would have started from the access to capital through banks wanting to lend for business purposes. Very rarely do they, well, not very rarely, but it's a lot harder to get cash out on your property for business purposes through the banks. And even currently at the moment, as interest rates are going up and that 3% buffer is still there, and having to have financials and tax returns and BAS statements and everything done and everything up to date to be able to get it through the bank, the businesses don't have time. We're in a world that moves so quickly that 6 or 8 weeks down the track, the opportunity is going to be gone, or the problem might then be insurmountable. So they need to be able to work quicker. And the short-term lending has been able to do that. It's been able to introduce something that can be done, what a bank might take 6 or 8 weeks to be able to do by the time they've done all the valuations and the credit and the financials and the mortgages and what have you. We can legitimately, as an industry, do in 24 to 48 hours. And that makes a huge difference.
Yeah, and that must have been a big driver behind the scenes as that became more and more aware that, people go, well, that solves a problem that I didn't think I was going to dig myself out of, because the bank was going to take 2 months to get from point A to point B sort of thing, let alone settlement. It's interesting when you look at the mechanics of these things behind the scenes to what actually drives them. And the one thing, I guess, with a lot of things, and specifically in your market, interest rate's not the driver.
No. Interest rates never been a problem. So people have said to me for many years, like, how do you sell someone on 2% a month? Well, I'm never selling them on 2% a month. They say it's 24% per annum, Cam. Like, no one's going to take a loan at 24% per annum. You're not selling them on the rate. You're selling them on the solution. And yes, there is a cost to that solution. But if I can fix that problem for you, whether it's the director's penalty notice for the tax that didn't get paid through COVID, whether it's settling on that block of land that you're selling as a house and land package, but you need to settle for 3 months, is that solution worth 6% to you because it's going to take 3 months to do it? Well, if the upside in the profit is 50%, it's going to cost you 6% to do it. You're not selling them on rate. You're selling them on solution versus outcome. Yeah. And that's always been the difference. And one thing that I speak to brokers a lot about, you cannot sell our product to somebody that doesn't need it. You can't, it might only come across broker's desk once a year or twice a year. It's not something that you can go to every one of your business clients and sell them into a Strive Financial or a short-term loan over the next 6 months, because if they don't need it, it doesn't serve a purpose for them, either solving that problem or taking advantage of that opportunity. Then there's no need for them to do it. But when there is a problem or there is an opportunity, the cost of taking advantage of it is neither here nor there to the business typically. Yeah.
So what sort of person uses short-term money? And I know it's obviously solution driven, but and it may have been different in the past. I don't know if you know that. Like, is what we do today the same as what we did in the past, or has that evolved and changed too? But is it mum and dad first home buyers that use this sort of money? What sort of person would come and say, I need help from yourself?
Yeah, so typically someone that's running a company, and most SMEs, right? So they're typically small businesses, mum and dad, directors, shareholders of the business that own their family home. They'll have a debt to CBA or what have you. But then why they need the money is a range of different things, but there's always a timing issue. They need the money for to pay a tax debt because they need to get the refinance done on the house, and the bank won't do the refinance whilst the tax portal's not clear. They need to settle on a property. They need to pay wages, but they're waiting on a creditor paying them. We do a bit of that stuff, right? You don't pay your wages on Friday. The staff aren't coming on Monday. Now, if you're waiting on a creditor paying you to pay your wages, then if it's going to cost you a couple of % a month to make sure your wages are paid on time, but that means your staff turn up, then again, it's a small price to pay for your business grinding to a halt because of that cash flow situation. So there's all number of different issues that people will borrow this sort of money for. And we're seeing a lot more of it. We're as busy as we've ever been, Whitey. We've done 30% of our annual loans that we would typically write annually, we've written in the 25 days of May.
Jeez.
30% of a year's work we've done in the first 25 days of May. Now, talking about driving factors before, for people to need short-term money, there needs to be some tightening in the credit from banks, and it gets a little bit harder, which we've seen with interest rates and what have you. There seems to be a bit of a tightening around the cash flow lending as well. That seems to be slowing down a little bit because the economy is not quite as good as what it was. Yeah. And people have all got 50% more equity in their property than they had 3 years ago. Now,
the way property prices have gone up.
With the way that property prices have gone up. Now, they may have come back 10%, but they went up 70, Whitey. So, and this is, I know you have your battles with the media, but the media drive me nuts around this stuff, right? It's all doom and gloom. It's the end of the world because property prices have come off 8 or 9%. Well, they went up 70.
Yeah.
So
they lose sight of that.
They lose sight of that.
Up, you've come back a bit, but you've landed at a new high.
It's neither here nor there, right? Your property was worth $1 million. You went through COVID, it was worth 1.7, and it's come back to 1.6. You're still 600 grand in front. I argue the same thing around interest rates. And again, you've been borrowing money a lot longer than I have been. But when I first started borrowing money in the early 2000s, I was paying about 8.88%. Now, 2% is not normal. Anyone can tell you that's 2%, unless you've only had a home loan for 6 months. 2% is not normal. Anyone will tell you. When I can remember they went down to 6.17, and I thought, this is the cheapest money in the world. This is the greatest thing that's ever happened. So although they're back at 5 now, if you had told anyone over a period of time that 5.5% was going to be expensive, they would have laughed you out of the room. Yeah. It's just that we've had that period for that couple of years, and maybe some people have locked in, or some first home buyers have got used to that number. But I still think interest rates historically are very low, even at 5.5% that we're at.
Yeah, it's had its time. And considering you keep chipping me on my age, back in the day when I was a young lad, I was writing home loans at 18.5% and business loans at 23. Yeah.
Yes.
But they were in a different economies, in a different marketplace. Cost of funds are a lot more expensive. And the period we've been through over the last few years, and so this is my 45th year of being in this industry, I've never seen interest rates this low ever, let alone interest rates stay low on a comparative level, but for such a sustained period of time. And then you then back that and say, I still have never seen interest rates rise so quickly for so long, 11 jumps in 12 months.
Yeah.
These things haven't happened before. So I can understand there's a lot of challenges, especially for the SME and commercial borrowers in Australia, who are looking at saying, well, I'm impacted by this, whether it's my home loan, whether it's my business loan facilities, whatever, it's all impacted by very unusual marketplaces. And that's why I wanted to have this conversation, because I think it's really important to understand how valuable the private lending sector is to our marketplace, and especially in this moment because of the way the needs are being driven by market impacts and effects, let alone, and you touched on it before, the lending criteria that the banks apply and how they've changed with reflection of the markets, whether they're right, wrong, or indifferent, but they've changed, and it creates opportunity in the sector, but it also, I think more so, regardless of opportunity, it actually, as you quite rightly pointed out at the beginning, creates solutions. And people are looking for that to say, help me out, and they don't necessarily get that from the other side of the coin. So,
and that's where we find that the drive comes from, right? So the banks start to tighten up and credit becomes more difficult to get. And then on the flip side of that means that there's more opportunity in the market. So if we talk about the last couple of years through COVID, there was very little opportunity in the market because the government were paying your employees' wages with JobKeeper, and you didn't have to pay your tax, and you didn't have to pay your landlord because you couldn't get chucked out if you weren't. So there were all these measures in place, right, that meant there was very little opportunity for people in the industry. And sometimes when there's opportunity for a business, that means that someone else is struggling. And we're about to go into that, where credit is a lot tougher to come by. And all of a sudden, there's going to be businesses that have survived through COVID off the government handouts and what have you, that aren't going to be able to thrive into the future. And the businesses that are in good, strong positions with good access to cash, with good equity positions, will be able to take advantage of those opportunities that come up in the market. They may not be able to take advantage of it through their bank because it's harder to get that. But guys like us, if they've got good equity positions, can turn the money around in 24 to 48 hours, and there's good opportunities for them to take advantage of in this next sort of 12-month period that haven't been there for a substantial period of time. And I go back to the GFC. I was with Strive or Crown and Gleeson back then in the GFC, and we all sat under our desk for a week and panicked that the world was going to end and we weren't going to have jobs. And we had never written as high quality loans in our life as what we wrote through the 2 years of the GFC, simply because credit just stopped everywhere. So really good borrowers with really good equity positions, with really good ideas, with really good opportunities to take advantage of, couldn't get money from anywhere but someone like Crown and Gleeson. And as I say, we wrote better loans in that 2 year period than we've ever written before. However, you go through a COVID period where there's easy access to money and no one's under any pressure, and then there's very little need for that part of the industry.
Yeah. So, mate, what's the style of loans you write? Is it long-term P&L? Is it short-term interest only? Is it capitalized? What are the sort of loans that people look for when they come to you, or you have available to provide that solution for them?
Yeah, most of them will all be interest-only loans. And typically they're sort of anywhere from a month through to 12 months, but most of them are sort of six to 9 months while people are getting their, so the exit strategy is really important, how they're going to pay the money back. So they're either getting a refinance organised, but they need to get their tax up to date. They need to get their tax portal up to date. They might be won a new contract. They're going to get paid 30 days end of month. So they're not going to see any cash flow for maybe 90 days until they can start paying that back. They've got the house on the market, they're selling it and they're moving on, whatever that exit strategy might be. Now, the reason we charge interest only, and this is where we differ from you guys that are doing cash flow lending, is that typically if a client needs a loan from us, they're typically trying to get from point A to point B. Now, when you take a cash flow loan, they capitalize the interest on top and then divide it by 12 months, and that's the payment you pay. So if it's 100 grand, it might be say 130 grand that you pay back over 12 months. They do 130 grand divided by 12, and that's your monthly payment. Now, you're talking it's sort of $11,000 a month that's going to come out of your cash flow to be able to pay that back over that period. Where when you're looking at something like us and more secured short-term lenders, you're looking at someone that's got a problem at point A, but they're getting to point B, whether that be the refinance or the sale or the lump sum that's due on an invoice or whatever it is. So we don't want to destroy their cash flow over that period from point A to point B. So we do interest-only loans. So on 100 grand, the same scenario, it's costing them $2,000 a month instead of $11,000 a month.
Yeah.
Now the interest rate is the same. It's just we're trying to get them to point B being their exit strategy, which is when they'll pay back the $100,000 of the loan. Now, the cash flow lenders can't do that because they don't have security. So they obviously need to see lump sums paid back off their capital over that period of time that they're having the money. But all typically interest-only loans.
Yeah. So then it appears that in this particular sector, then the actual borrowing criteria seems to be largely around that exit strategy, and I guess the soundness of that exit strategy. It just can't be a pie in the sky dream sort of thing. Would that be fair?
Yeah, 100%, mate. So people say to me all the time, they say, Cam, you don't look at financials, you don't look at tax returns, you don't look at BAS statements. We don't do credit checks, so we don't impact their credit score on their credit file. How could you ever possibly lend money to someone like that? So there's the three things that determine whether we're going to say yes or no to a loan. Number one is the purpose, what they're using the money for. We hate it when people come and say, I want $100,000 business cash flow. Because we say, well, what are you going to do with $100,000? I want to know what you're going to do with $100,000 business cash flow, right? We had clients this week that were buying a water walker treadmill. They were horse trainers, and it was $98,000. Perfect, because I know they're buying a water walker treadmill, which is going to improve their business. They're going to be able to charge the clients for exercising their horses. Perfect, no dramas in the world. So number one, it's got to make sense, and we really want to know what the purpose is. We want to see a benefit for the client through the purpose. The second one is the security. What are they offering as security? So we're looking at what the property's worth, what their first mortgage is, and how much they're looking to borrow. And people ask me all the time, what LVR are you going to lend to, Cam? Well, I don't really have one, because we put all these three things in the mixing pot, and out comes what we're happy to lend you. Because if your purpose is no good and your exit's no good, then we're probably not going to do the loan no matter how good your LVR is.
Yeah.
Because it doesn't make sense. So we want to see a purpose that makes sense. What's the security? And then the exit strategy. So are you refinancing your house once you've paid out the tax debt? Are you going to generate more income for your business, and you are going to be able to pay it off over a 12-month period? Are you looking at selling equipment, or are you selling a property? Are you purchasing a container load of goods to put in your shop for Christmas, and the container's costing you $100,000, and the goods you're going to sell in your shop for $150,000? So, and they're the things that honestly go into the melting pot of saying, yes, we'll do a loan, or no, we won't do a loan. Because if any one of those three things don't add up and don't make sense, then we're just not going to do the loan.
So in that melting pot of the three things, looking at the security side, is it always just property, or are there other things that may, subject to if buts and whatever's, come into it?
We do a little bit of stuff, mate, and not as much anymore, but we have done some vehicles and some boats and some stuff like that. Probably I would say now 95% of it is a mortgage against a property, whether that be a first mortgage or a second mortgage.
Is it a standard property? Like, does it have to be a home? Could it be a factory, something?
Can look at anything. So again, that's just another thing that goes into the melting pot. People say, will you lend in certain postcodes? Now, we'll look at lending anywhere. We lend in every state. We've lent in country Queensland. We lend in Albury, Wodonga. We'll lend anywhere, but again, that's just part of it that goes into the melting pot to say, okay, really, really good purpose, really, really good exit strategy, but the property's in central Queensland, we'll do 60% of it, where if the property's in central Queensland and the purpose is business cash flow and the exit is business cash flow, we probably won't do the loan. Do you know what I mean? It's not up our alley for what we want to do or what we want to look at. So they're the sort of differences that go into the melting pot. Now, I understand for the guys watching this and the brokers out there, that can be frustrating, because they would like to say, well, Strive Financial in this postcode is going to do this LVR, but we sort of don't work like banks in that way, because we're not looking at financials and tax returns and all of this stuff that says they earn this much money and this is going to be their monthly payment, paying it back over a 30-year period. We're sort of looking at, okay, well, what are they doing with the money? What security are they offering? How are they going to pay the money back? And those three things are obviously really important into our decision on whether we lend. Yeah,
so it's bespoke to the need and ticking those boxes.
Yeah, most definitely, 100%.
So tell me a secret. What's the most creative thing you've lent against, or unusual?
Well, I've got a couple here. So John and I... I'm
not holding you to it today either. I'm just thinking about it. This is just more of an interest factor for me.
Yeah. John and I are a bit funny, right? We lent against an aeroplane once and we said we'd never do it again, and we did it again because we always forget. But we're back on our probably 5-year plan of not lending against aeroplanes, and this is the second time we've been on that 5-year plan. So we shouldn't lend against aeroplanes anymore, but you call me in 2025 and I'll probably think it's a good idea again. We lent against a tourist attraction up in North Queensland, was a little yellow submarine. So it was a little well, yellow, funnily enough, submarine that went out.
Always under the water, brother.
Did the reefs and stuff. We lent against that. We started doing some crypto stuff, Whitey, when crypto was going through the roof probably 18 months ago. We have a set of documents that allows us to lend against a cryptocurrency the same as you would lend against a share. So it has a margin call on it. We'll lend a certain percentage of the value of it at the time, but with a margin call on it. The difference there is that the actual cryptocurrency gets transferred into Strive Financial's wallet. So Strive Financial actually hold the crypto coin. You pay your payments, you keep it below the margin call. That got a little bit interesting there for a little while, but so that was something that was a bit left field. When we started that, we had a lot of people ring wanting to lend against stuff that were very obscure that we'd never heard of. So we obviously only lent against the major couple of cryptocurrencies. We didn't lend against them all. Yeah. But that was something a little bit left field.
I like looking at the creative stuff, things that are outside the box. Hey, I got a question come through, and this would only be specific to business or commercial facilities, I imagine. But do you do construction loans?
We can look at construction loans. What we don't do is construction from go to woe. Yeah. So we don't do drawdown facilities as such, where because we don't have quantity surveyors and we're not developers. So if we end up with a half-built house, we don't know what we're doing. Where we can help with some stuff like that is quite often developers will get a property to say lock-up stage or fit-out stage, and they've used their own cash to get there, and now they need $100,000 to finish it. To get the driveways done, get it painted and what have you. So quite often we do stuff where we do it against the unfinished property. So there's a lot of guys out there that it's very difficult to go to a bank and get money against an unfinished property. Yeah. We are able to look at that. Now, the proviso on that is that all the money's got to be outside the Consumer Credit Code. So it's got to be for...
It wouldn't be home loan stuff. So
so it's got to be for business or investment purpose. So for us to put money into finishing a property, that property needs to be owned by a company or owned by a trust with a corporate trustee. So we do have them quite often, actually, where mums and dads come to us and they're in a really awful position where they've got their house to a certain stage, but they haven't got the money to finish it. The bank won't give them any money to finish it, and I can't give them any money to finish it because it'd be a consumer loan. And they end up in a very, very tricky position. Like the bank will give them the money back the minute that the house is finished, because they'll refinance and give it back, but they won't do it until it's finished. So there is a little bit of a niche market there where it's got very difficult. We used to be able to do it. I think it might have been Julia Gillard that changed the rule that said any residential property in a personal name was considered a consumer loan. It used to be that if it was an investment property, then it was outside the Consumer Credit Code. Even if it was owned in your personal name, it was still an investment property and therefore an investment. Where they changed that back in the day now that any residential property owned in the personal name is classed as a consumer loan. Now, that doesn't mean that people can't use their principal place of residence or a residential property owned in their personal name as the security for the loan. And this is where it gets a little bit tricky. People get a little bit confused. The security for the loan doesn't have to be non-coded security. The security for the loan can be a residential property owned in a personal name. It's where the loan funds are going to. So whatever I'm giving you the money for, that's what's determined whether it's a business loan or a consumer loan.
Use of funds. Yeah,
it's always the use of funds. So 95% of our loans are against residential properties owned in personal names. It's just if somebody come to us and said, "Oh, I'm buying a house in my personal name. Can you do the finance because it's fallen over with CBA and it's going to take me another month to get it?" Then I can't help them with that. It'd need to be purchased in a company name or a trust.
No questions come through, and I don't know if you do this or not, but second mortgages secured by caveats. Do you do that?
Yes.
Does it have to be mortgage secure?
No, so it's all a mortgage now. So the way it used to work, and technology's been fantastic in this instance, Whitey. I can remember when I used to have to sign up a loan in Sydney, and then I would walk down.
Land title's office.
Yeah, and before that, you had to go down to King Street, I think it was on, and get the caveat stamped by Esprion, I think they were called. They had to stamp the caveat, they had to stamp the mortgage. Then I had to walk up and sit at the titles office, get a number, wait for them to call my name, and then they would lodge the caveat. And then the bank would hold the title. So you had to write to the bank, ask them to send the title to the titles department. Then we would have to send our second mortgage down, and our second mortgage would replace our caveat.
That was a simple exercise.
Oh, so simple, Whitey. It was so good. So people used to say all the time, do you lend against caveats? And I'd say, yes, we do lend against the caveat, because that's how we can turn the money around within 24 hours, because it would take you 6 weeks to get your mortgage lodged because the bank had to produce the title. But we always had the second mortgage signed, and it would be lodged once the bank did produce the title. Nowadays, with PEXA, you can virtually lodge your mortgage instantaneous. So the only place we have to lodge a caveat anymore is in Victoria, because there's still certificates of title in Victoria. So we lodge a caveat via PEXA in Victoria until the bank issues the title when we lodge our second mortgage. So we don't lend against a standalone caveat. We don't lend against just the caveat, to answer the question. There's always a second mortgage signed. In Victoria, the caveat still holds our position on title until we can get that second mortgage lodged.
Right. Well, thank you. And this is obviously somebody's got a specific thing in mind. But so the second point after this was: is there a minimum loan amount, and are there early termination costs?
Yeah, perfect. So minimum loan amount's 250,000 through to 25,000 through to 2 million. So we do a lot of smaller loans. We have two products. One has no minimum term. It's a little bit more expensive. It's 3% a month. But if you have the money for 1 month, you pay 1 month's interest, and that's it. Our 2% a month product is a minimum 6 months term. So you are liable for the 6 months if you pay it out early. Now, on fees and charges, mate, a really important one for everyone out there. We don't have any upfront fees or charges, so no establishment fees, application fees, valuation fees, commitment fees,
CAM fee,
line fees. I love Cam needs a new shirt fee. None of that stuff whatsoever. And when your client pays the loan out with us, the only exit fee is a $250 cost, which includes the cost of releasing the mortgage off their title. And I think that's about $239 or something. So we make it about $11 out of that. We do have a document fee of $3,450. Now, I understand on smaller loans, on a $25,000 loan, that seems expensive, but on a $2 million loan, we charge the same. So we're not somebody that charges a 1% documentation fee. Casey does the documents, and whether she types 25,000 in the mortgage or she types 375,000 in the mortgage makes no difference to the cost of doing the documents. Now that fee includes all registration costs. So it includes the registering of the mortgage, it includes the documents, it includes the sign up. If I need to fly to Perth and meet with the client, it includes that. It includes everything. So there's nothing else to pay, and that's capitalized on top of the loan. So the client doesn't get charged that upfront.
So even if it exceeds the LVR, so say you're doing a 70% lend, if you're capitalizing that cost and it takes it to 71%, that's okay?
That's all fine. So, Yep, most definitely. So when we look at a loan, if the client wants 100,000, we're looking at it as there's the loan prep fee and the first month's interest and stuff. So we're looking that we'll always give them the net 100. If we're not comfortable with that, we might go back to the client and say, listen, really sorry, we can't do 100, but we can do 85,000 or whatever. We'll always try and come back with what we can best do to try and help the client out.
Yeah. Hey, very interesting. I just had another question come through. It's exactly, pretty close to being on par with what I was about to ask you next. But I was going to dive into the little bit about some trade secrets. Where do you get your money from? But I still want to ask that question, but somebody has
Yep.
come sent a message through, a question come through saying, if I have investors wanting to put funds into Stripe, are you open to it? So
Listen,
and where do you get your money from?
And where do we get it from? Perfect. So we do have a wholesale license through ASIC. So we can raise money from sophisticated investors. So that's the catch around the investing side of it. They need to be able to get a sophisticated investor certificate from their accountant. That's number one. Number two, we don't take on a lot of new investors. We're a fairly niche little company. A lot of the guys have been with us since 2002 when Warren started it, and probably the last people we put on were about 4 or 5 years ago. So we guarantee our money. So Strive Financial has its own money and our own personal money. So when your client gets a letter of offer, that's us guaranteeing that we will fund it with our cash. We obviously don't have enough cash to grow then, but we guarantee it, and then we have a group of sophisticated investors that decide it's a contributory mortgage fund, so they contribute into each individual investment. So we don't have a pooled fund, which is where people just give you money and you start paying them interest from the day that you get the money, and then I can do whatever I want with the money. These guys contribute into individual investments, and they decide, yes, I want to put money in that loan. No, I don't want to put money in that loan, what have you. But the thing I want to stress there, and when I say it's all our own money, we're not just a middleman. When your client gets a letter of offer from us, that is Strive Financial saying we will give you that money. There's never an issue with us ever where you'll ever hear from us after we've issued a letter of offer to your client to say, oh, sorry, we couldn't raise the money, or, oh, sorry, we're expecting this loan to pay out and it didn't pay out, so now we don't have the money to do your client's loan. Yeah. That is impossible to happen with us.
Yeah. Okay. Oh, well, it's a good understanding. Hey, I'm going to backpedal a little bit to the previous questions around caveats. So I think this is a follow-on probably from the same person, but saying here, what if the first mortgagee would not entertain consenting to a second mortgage? And I don't know if there's any banks that have been in that position, but what happens if they don't consent? Would you be happy with an unregistered mortgage position through a caveat?
Yeah, so first we'll go on the banks. Everybody has a legal right to have a second mortgage. So a bank can't actually refuse that to happen. They can not consent, but they still have to produce the title for us to lodge our mortgage. So the consent thing is whether they consent, they don't consent is neither here nor there. We've only ever had one in my 20 years that I know of, or almost 20 years that I know of, where we had to send them the legislation that said you don't have any choice but to produce the title. 95% of them, or more than 95%, 99% of them, they just all lodge via PEXA. We send them a letter because we don't get a deed of priority or anything from anyone, Whitey. So this is why we can turn the money around as quickly as we can. We check the bank details, or we check the client's loan details over the phone whilst we're with them signing them up. So we just ring the 131 number. The client identifies themselves and we just ask, what's the balance outstanding? Do they have any arrears? Do they have any other credit with CBA? So that's how we satisfy ourselves what we're lending behind. And then the mortgage is lodged straight via PEXA, and we would then send a letter just saying we've lodged this mortgage. Please notify us if and they don't lend any more money to the client. The answer to the second part of the question is no. We don't lend against the caveat without the registered without the registered second mortgage, even if it's signed,
or even an airplane or submarine.
Yeah, we do still want it registered. And listen, one of the things I talk clients through here, mate, and I do this a little bit, is because some people do say, I only want a caveat, not a mortgage. It doesn't make a great deal of difference anyway, because at the end of the day, if you don't pay, you'd still have to go to court under the caveat to get the property to be able to recoup your funds, which happens next to zero times with the amount of stringent things that we have in place to make sure that the loan makes sense and the loan is going to pay out. We very rarely ever have to go down that track. But I simply say to the client, listen, if you intend on paying the money back, whether it's a second mortgage or whether it's a caveat, it makes no difference whatsoever. If you don't intend on paying the money back, then I don't want to give you the money anyway. At the end of the day, and that's purely my simple response. Do you know what I mean? If the difference between a caveat and a second mortgage is it's more difficult for me to collect if I have to collect. Now, if they think I'm going to have to collect, which is why they want a caveat lodged, then I don't want to lend money to them anyway. So that's sort of as simple as I sort of make that with the client when they do ask me around that.
Yeah, you're saying you're not a charity. You expect to get your money back.
I'm definitely not a charity. It's we try and do the right thing by everyone. And this is a funny. I speak to brokers about this a little bit as well, because they say, "Oh, surely you're going to take some more risk. You're charging 2% a month. Like, surely you're going to take some risks on." But at the end of the day, we charge for the service that we offer. And the service that we offer is that you can ring me today and have $2 million in your bank account tomorrow, or 50,000 or whatever. And we'll drop everything. We'll have documents done tonight. We'll fly to Perth. We'll meet with your client. We'll have the money in their account. So you're paying for a service rather than paying that I'm going to take risks on dodgy clients or dodgy property or dodgy security. And that's just not how it works. Because if you don't get your money back, if you don't get your capital back, it doesn't matter how much you charge. You can charge 5% a month. If they pay for 3 months and then don't pay you the capital back, you're still down to 85% of your money. So it doesn't matter what you charge. If you don't get your capital back, you're losing and you're going to go broke.
Yeah, exactly. Mate, we're getting near the end of our session here now. It's gone by really, really quickly. Hey, one, and these have all basically been without notice, but another one without notice. Mate, what, hang on a sec, another question comes through. We might deal with this quickly before I go to that next bit, as long as I don't forget. I'm getting old. What was in my mind a minute ago will be gone. Would the first mortgagee be wanting you to acknowledge their priority?
Yes, so quite often they do. So we satisfy ourselves by speaking with the bank over the phone. When we write to them, typically the bank will write back and say, here's our deed of priority, we're owed XYZ, which we're already fully aware of because of the conversation that we've had with the call centre over the phone, which is the way that we can turn money around quickly. So in the short-term lending, a lot of people will promise you they can turn the money around really quickly, but then they want a deed of priority or they want a registered valuation done, or it takes weeks and weeks and weeks. So that's how we satisfy ourselves around what we're lending behind. At the end of the day, the bank's secured in front of us either way. So they do usually send that through, which we have no problems with.
You lend on properties overseas?
No, we don't. We have looked at going to New Zealand, Whitey, and we've sort of looked at it a few different times over the last sort of probably 10 years, but we've sort of just never got around to it. We don't have the expertise over there. You have to get new lawyers and new investors, and we sort of never got to it.
Overseas properties are out. Another one, just quickly, is how do brokers get paid generally? Separate?
Yeah, brilliant. Great question. So it's capitalized on top of the loan. So the broker can charge as much or as little as he likes. It's mandated fee. It's capitalized on top of the loan. It's all fully disclosed in the letter of offer, but we pay the broker up front. So if you send me the application today and tomorrow the client gets their 100 grand, your 5,000 goes in your account tomorrow as well. Definitely no clawbacks or any. If the client pays out after 1 month, they pay out after 1 month, and the broker will make more money than what we make on occasions, and that's fine. It's not a problem in the world. Typical brokerages, nothing would start below sort of 2,200 typically, and typically 2.2%, 3%, somewhere around there. And then if you get to the higher ends, like if it's $1 million deal or a $1.5 million deal, it might be back to a sort of a locked figure. There's usually not much stuff over sort of 10 grand. But again, you're filling in a 2-page application. You're filling in a 2-page application form, sending through a rates notice and a mortgage statement, and literally, typically in 24 to 48 hours, that 10 grand, 5 grand, 2 grand's in your account.
Yeah, better than car asset finance.
We try and keep it simple.
Yeah, mate, excellent. So the question I was going to ask you: do you have any final secret hints? What's the key to this recipe? Do you have anything there?
Oh, listen, the one thing I've spoken about for many years, Whitey, and I'd love people to take out of this again, is understand that short-term lending can be really beneficial to your client. However, you need to understand what you're doing. And the greatest takeaway I can give you is that it's very rarely about the interest rate in short-term lending.
Yeah.
Very, very rarely is it about the interest rate. You'll get a headline interest rate of 1.39% a month or blah, blah, blah. It's everything else that goes with it. It's how much is the exit fee? How much is the application fee? How much is the establishment fee? How much have they got to pay up front? Something that's creeping into the industry a little bit is that once they've got your client paying it up front, they've virtually got them on the hook. And then they can change their terms and conditions because they say the valuation came in lower than what we expected it to come in. Now you don't fit in our 1% a month product. You're in our 3% a month product. And you've paid $7,000 up front, and now the client's on the hook. They're going to lose their $7,000. They end up taking the 3% a month product. Very, very rarely is it about the interest rate. And if I could just encourage people that when you get the letters of offer and stuff, ask questions. Ask what the exit fee is. Ask what the application fee is. Ask what the loan preparation fee is or the document fee is. Are there line fees? Are there monthly fees? And then have the ability to work out, okay, it's actually going to cost X, rather than just saying, oh, I found you one at 1% a month instead of Strive at 2% a month, because very rarely are those cheaper interest rates in our space cheaper than the guys that don't have the fees and charges. Yeah.
Right. Mate, thanks. It was a lot of fun. I enjoyed that, and very insightful. So hopefully everybody enjoyed the conversation today on Q&A. So, buddy, thank you and all the best. And
pleasure, mate. Thank you so much for having me.
All the best. Take care. Speak to you soon.
Cheers, guys. Bye.
Cheers, mate. Private lending. There you go. How cool is that? So some interesting stuff to learn from there. So let's, we're going to call it quits for today. Keep an eye out for next month's webinar. Some another great speaker has come to, great presenters come to speak with us on Q&A. Be a lot of fun. And also don't forget, we've got our Broker Elevate series, some magnificent speakers speaking on this current lap that we're doing in the country. And we've got Hobart and Adelaide coming up next. So if you're in those states, make sure you register and attend. Hobart, well, they're both next week, actually. Yeah, so make sure you attend. And it's a very, very cool series. So very good fun. So, and again, thank you to our sponsors. We do appreciate your support. Wonderful people enabling us to bring all this content to you free of charge. And with that, you'll get a code come out to you for your CPD session for this. And also we'll ask for a bit of feedback as well. And if you haven't been able to stay for it all, you'll be able to watch it back again on our YouTube channel. If you want to refresh your memory on anything, watch it on YouTube. It'll be there for you. And thanks once again for being with us. All the best, and we'll see you again soon. Take care. Bye for now.